Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with Paul Sheard, who is a whiz at monetary policy. He has had several past positions, many of which you'll want to take a look at on our website, but most recently he was a research fellow at Harvard Kennedy School. So Paul, thank you for being here.
The pleasure, Rob.
Paul is the author of a book that asks a deceptively simple question, which I think most of you will jump to say you know the answer to, but we're going to try to rechange that a little bit today. The book is What is Money? Paul, could you tell us what money is, please?
Sure, Rob. And actually, it's the power of money.
The power of money.
A little bit stronger. But yeah, the book is really all about money. And, it starts with that basic question, what is money? And the standard question is, the answer to that question, of course, is goes way back to the 19th century famous economist William Stanley Jevons, who talked about the functions of money. And for something to classify as money, it has to be a unit of account. We measure things in it. A medium of exchange, we use it to exchange, buy goods and services and assets, and a store of value. We can use it to transfer purchasing power through time. And so that's a kind of a functional definition, but that really touches on, I think, a key aspect of money, which is that it really represents purchasing power.
Right.
Purchasing power that can be used to deploy into the economy today, purchase the goods and services that are produced, or it can be held over to the future through holding money or holding some kind of financial asset. So that's sort of what money is. But what I'm interested in particular in this book, certainly for the first couple of chapters, explaining a little bit more about where money comes from. And by that, Rob, I don't mean the historical development of money. It's a very interesting story, but there are hordes, loads of books that kind of go through the history of money and the whole centuries and millennia of that.
It's a 7-hour podcast somewhere out there on the internet.
And I'm not an economic historian, but I'm more the question which is less focused on, which is sort of money, keeps coming into existence as the economy grows. Mm-hmm. So for example, if you went back 10 years, today there's about, depending on how you measure it, and of course economists have all these different measures, M1, M0, M2, etc. But kind of standard one would be M2, which is basically cash and bank deposits, roughly speaking, time deposits and savings deposits. There's about $21 trillion of that money in the US economy as we speak today. But if you go back 10 years, it was about half that level, a little bit more than 10 trillion. So, while we weren't looking, where did all this $10 trillion of money come from? And so I sort of try to explain that. And, a lot of people would say, well, that's pretty obvious. Central banks create money, they print money or whatever. But it's actually a little bit more complicated and worth disentangling. And there are really three key sources. Almost you can think of money as kind of like a bathtub. Mm-hmm. And money is pouring in and sometimes money is withdrawn. And as the economy is growing, the bathtub gets bigger and bigger and you need more money in that bathtub.
Right.
Kind of, some people use that analogy.
Right.
I don't want to take it too far.
Right.
But the first and most important place that money comes from is banks creating money when they lend. That's why we call it bank credit creation. Credit creation is money creation as well. And there's a lot of misunderstandings, even about something as simple as that, Rob, because a lot of people say, banks, when they lend, they take in deposits.
Right.
And then they use those deposits to lend to people who need it. Well, you or I might do that if I lent you $20.
Right.
But banks don't function that way. They actually create the money deposit when they initiate a loan. Now, that money then, that deposit will typically move from that bank and circulate in the economy.
Right.
So to an individual bank, it kind of feels like, deposits are flowing in and, they're accumulating on their balance sheet, but it's not a process whereby they take in deposits and lend them out again.
Okay.
The second, and that has various implications we can maybe come back to. The second main way in which money gets into the system is by governments printing money. But what that basically means is governments running a budget deficit, and government spending injects money into the economy. It's created out of thin air. And of course, governments withdraw money through their taxation. But most governments, most of the time, are running a budget deficit. And that budget deficit is also creating money. Now, again, we don't usually think of it that way because we're so used, particularly in the financial markets, to thinking about, well, hold on, don't governments have to borrow money to finance their budget deficit?
Right.
And they have to issue bonds, and that gets money in their hands, and then that finances the budget deficit. And kind of at an institutional level, it kind of looks like that and to a certain extent works that way. But one of the things I do in this book is make a couple of important distinctions. One is between the monetary economy and the real economy.
Okay.
Another one is between how things operate at a fundamental or underlying level, and then how they operate at an institutional level. And they're quite different. So at an institutional level, yes, it does look like governments have to issue bonds, but when they're issuing bonds, they're actually kind of soaking up or sterilizing money that either they have created with past budget deficits or they're about to create. So one just offsets the other.
Okay, so let me back up for 1 second.
A little bit complicated.
So when you used the word sterilize there, I wasn't sure I understood the metaphor. I understand, like, we're financing this year's budget deficit and perhaps maybe the next fiscal year's budget deficit, but sterilization.
Sorry, I slipped that term in because it's often a term that's used more in the context of foreign exchange intervention and sterilizing that.
Okay.
But in the book, again, I kind of introduce, I've written about this before, but a concept of the monetary Garden of Eden, kind of betraying my Catholic upbringing. and basically make the point that if you go back to sort of that basic fundamental level and think about, so what happens when a government runs a budget deficit? And imagine for a moment, there's not a separation of monetary and fiscal policy or functions within the government. That's why it's the monetary Garden of Eden.
Right.
Essentially, say if a government ran a budget deficit of $100, it would be creating in the banking system $100 of deposits.
Right.
Because net $100 has been injected.
Right.
On the bank's balance sheet, the bank will now have $100 of reserves, that is deposits at the central bank or with the government. That's just pure money. But sterilization is the idea that the government will issue $100 of bonds.
Right.
And now let's say you had that $100 deposit, you buy that bond, you now have a bond, not a deposit. So that money has sort of been sterilized.
Right.
And likewise on the central bank, the bank's balance sheet, that reserve will have been sterilized or expunged. This actually leads me into another point where I'm a little bit different perhaps from your average kind of textbook economist. Economists have this habit of not thinking of government bonds as money. They're government bonds. Money is this M stuff, M1, M2, M3 sometimes. But I think from an economic perspective and thinking about things like inflation, money printing, debt accumulating, etc., government debt, it's actually better to think about government bonds as a form of money.
Right.
It's just, again, in a form that is just one step removed from what we normally regard as money.
Right.
By the way, just to finish off the story about where money comes from, the third one is, of course, central banks. Central banks, when they do quantitative easing, for example, expanding their balance sheet, they're buying government bonds, and they're creating deposits in the banking system and reserves as an asset on the banking system's balance sheet. But again, when you think about that, that's really not creating money in the sense of net purchasing power, but rather, in my view, changing the form in which money exists, because they're buying treasuries. Well, then you have to say, where do those treasuries come from?
Right.
Well, if you trace it back, those treasuries were associated with the federal government at some point running a budget deficit, creating net money that was then turned into treasuries, and now the central bank holds them on its balance sheet. But it's not the underlying fundamental way in which money gets into that bathtub in the first place.
Right. That is fascinating. When we were prepping for this, it took me about 30 seconds to think through, what do you mean it's creating money when they issue bonds? And then I thought, oh, yes, it is, of course. So I hope everyone on the podcast is having that moment now too. So one of the things that I'd like to shift to now a little bit, sort of now that we've established what money is, once again, a deliriously simple but also complex question. We talked a little bit about some of the things that happened policy-wise over the last couple of years that led us to here, because we can't talk about creating money without talking about inflation. So we're going to put a pin in that and get there for a second. I thought there was something really interesting you pointed to that was in TARP that is now coming to roost. So could you talk about that a little, please?
Sure, Rob. I think you're referring to the Fed now being able to pay interest on reserves.
Exactly.
And that's a really important fundamental shift in central banking. You mentioned TARP, that legislative change, because prior to 2008, October 2008, the Federal Reserve legally was prohibited from paying interest on reserves.
Right.
The money that banks are holding at the central bank, which is a component of monetary base or base money. And this was already in the pipeline, actually. Legislation had been passed earlier, I think it might have been 2006, that in 2011, the Fed would be able to start to pay interest on reserves. But when the TARP legislation, the Troubled Asset Relief Program, that legislation was passed in October 2008, that was slipped in. And so why was that? Well, I think the Fed was looking ahead and realizing going into pretty troubled waters, and it would be very handy to have an additional tool that is the ability to pay interest on reserves. Now, why is that important? Well, from a monetary policy point of view, it's really a game changer. And why is that? Because prior to October 2008, the way that the Fed and most central banks in developed worlds operated was they targeted an overnight interest rate.
Right.
But they were not, and they did that by essentially, what is that overnight interest rate? That is the interest rate that banks are charging one another in the interbank market, overnight interbank market. Well, they're lending essentially reserves to one another.
Mm-hmm.
Well, if the Fed is not paying interest on reserves, then it really cannot afford to supply more reserves than are strictly needed by the banking system. Why are they needed? Because they have to satisfy minimum reserve requirements.
Right.
If they were supplying more than, and that number, by the way, pre-crisis was about 45 billion-ish, right?
Okay.
So if they were supplying, say, 80 billion and expanding their balance sheet, some banks in the system would find themselves with excess reserves. Those excess reserves would pay zero.
Right.
And they'd be wanting to offload them. And the process of offloading them, that is trying to lend them to some other bank, would essentially force the interest rate down to zero. And the reverse works as well.
Right.
That if the Fed didn't supply enough reserves, say they only supplied 30 billion rather than 45 billion to the banking system as a whole, banks on average would be short of reserves. They'd be scrambling to borrow reserves from other banks, and that would be forcing the overnight interest rate up.
Right.
So it's a corollary of a scheme of a monetary policy scheme where the central bank is targeting the overnight interest rate but not paying interest on reserves.
Right.
That it cannot arbitrarily expand its balance sheet. Its
Right.
balance sheet just accommodates whatever the demand is for money in the system. That's really important. So why is that important? Fast forward to the financial crisis and then again COVID. The Fed now, its balance sheet is something like 8.4 trillion.
Right.
It's got about 3.3 trillion reserves on its balance sheet.
Right.
And it's paying interest on those reserves.
Exactly.
And what that allows it to do is separate the interest rate decision from the balance sheet decision.
Right.
It can essentially target high or low interest rate, have a big or small balance sheet, and make those two monetary policy decisions independently of one another. And that's a very powerful kind of tool. Now, there's a lot of misunderstanding about this as well, because you hear a lot of people, economists, who say, the Fed is paying interest on reserves to kind of incentivize the banks to keep parking their reserves at the Fed as if the banks had any alternative.
Well, yeah.
And one of the dirty little secrets of the way these things work is that the Fed or any central bank operating in this kind of system gets to control the aggregate level of reserves.
Right.
So in aggregate, the banks have no alternative at any point in time to holding those reserves. So the purpose of the Fed paying interest on reserves is what they're doing now, which is they want to tighten monetary policy.
Right.
But they don't, for various reasons, want to dramatically shrink the size of their balance sheet. They think that would be too disruptive to the bond market in particular. They want to rely on the tool, the overnight interest rate, that they feel most comfortable with. And they can do that even with this very bloated balance sheet.
I mean, there is, I would gather there is a pretty good concern about the uncertainty that might create, particularly when you have the high yield market in the position it's in right now. It wouldn't take much.
Well, Robert, it's a very funny thing. Again, just from a high level here, when central banks went into QE was the last easing tool that they did. They exhausted their interest rate ammunition. It was sort of last in, but it's also kind of last out.
Okay.
I mean, logically, you might think, well, why wouldn't the Fed do quantitative tightening before it did interest rate tightening? But it's not as comfortable and confident about the transmission mechanism. And it has this policy which is much more of a kind of a regular kind of rolling off of treasuries and MBS off the balance sheet in a very kind of pre-programmed regular way, which basically kind of it's almost soporific. The bond market just kind of like, okay, another 20 billion rolling off. Whereas if the Fed was selling 100 billion here, 100 billion there, it could dramatically reduce the size of its balance sheet, and that would be monetary tightening.
Right.
But it would be rather kind of unpredictable in what effect it would have.
Right. And I don't envy anyone at the Fed right now because the decisions are difficult. So
you bet.
And you don't want to add the uncertainty of that to it. So one of the other things I thought was fascinating as you talked about here, we're just going to kind of go through another high point in the book, is the portfolio rebalance effect, which you've touched around here. Please take a crack at that.
Well, that really speaks to quantitative easing. And there's a chapter in the book on QE, chapter 4, and I have a long history because I was kind of at the coalface in Japan in 2001 when the Bank of Japan launched its first, really pioneered quantitative easing.
Yeah.
So what is quantitative easing? Well, that's simply the central bank going out and buying bucket loads of usually bonds,
lots of
and creating
stuff.
excess reserves.
Yep.
Okay. Well, what's it supposed to do? How does it work? If you talk to, say, Ben Bernanke, go back and look at his speeches, he'd say, well, it works through the portfolio rebalance effect. At which point, most people's eyes kind of glaze over. What exactly is that? I prefer to talk about it in terms of what the Fed does, or Bank of Japan, or ECB, or any of these central banks, when they buy a whole chunk of, let's call it government bonds, government debt securities. Could be other stuff as well. They're taking those assets out of the aggregate portfolio held by the private sector, and they're supplying dollar for dollar, yen for yen, euro for euro, a different asset, central bank money, and also creating bank deposits. And so that's essentially what QE does, is sort of disturb the aggregate, the composition, alters the composition of the aggregate portfolio that is held by the private sector. And I like to think of this so what does that mean? Then those portfolios will be rebalanced. That's where that comes from. But that's not very illuminating. I like to think about it and talk about it in terms of asset price equilibrium.
Okay.
That think of, and again, asset markets are very dynamic, so they're never actually in equilibrium. But you can have a mental thought experiment of saying, well, if we just froze the world at a certain point and every investor in the world optimized their portfolio and securities prices and the yield curve and everything would be kind of finding its level, you would get to some kind of asset price equilibrium,
right.
which reflects the preferences of investors and the stock of assets out there. So now the central bank comes along and purposefully, and on a fairly significant scale, we're talking trillions of dollars, disturbs that composition. That will then disturb the asset price equilibrium.
Right.
And in particular, it creates a whole bucket load of reserves, which usually when you're doing QE are receiving either zero or close to a zero interest rate.
Right.
And so banks and other entities holding assets are now holding cash, let's call it cash, zero interest rate. And they say, I don't really want to hold this much cash. I sold those securities, but I'd like to now deploy this cash. And what they'll do is, start chasing yield, maybe redeploying into risk assets. So portfolio rebalance effect to me is the effect of shifting from one asset price equilibrium to another. And during that process, financial conditions are being eased. Interest rates are being pushed down, equity prices being maybe pushed up a little bit, maybe downward pressure on the exchange rate, all other things equal.
Mm-hmm. Yeah, this is fascinating. Now, this is where we bring around to the current thing. This is a great layup for this question that I was asking you about how you think the policies of the last decade impacted the inflation issue that we have right now.
Well, that's a terrific question. And of course, it's could have a long answer. Let me try and keep it short. But in a nutshell, the inflation shock that we experienced in really 2021 into 2022, and now even continuing, was related to COVID. And in two senses. One is and it's really, was it COVID or was it the policy response to COVID? The first thing that happened, of course, was the economy was largely shut down. First half of 2020 in the US, GDP fell 10% non-annualized. That's about 20% annualized. So that was a massive shock.
Yeah.
Unemployment rate went up from 3.5% February 2020 to 14.7% April 2020. 2 months, 11 percentage point increase in the unemployment rate. We have never seen negative economic shocks on the scale concentrated into such a short time frame.
Right.
Ever in the history of economic data. I challenge someone to come up with that data.
Yeah.
Throw the challenge out. The Great Depression was pretty bad, but it happened more gradually.
Right. It was much longer. Yeah.
But then, of course, we had the monetary and fiscal stimulus and, massive increase in government deficits, debt levels, and then we had massive quantitative easing or credit easing by the Fed. They took their balance sheet from 4 trillion to 8 trillion. What I think the Fed and the government, to the extent that it kind of focuses on these things in the way that the Fed does, you could say, what was the forecasting error? Clearly, there was too much money created relative to the ability of the economy to produce goods and services. Now, sort of two questions. Whose fault was that, monetary or fiscal policy?
Right.
And apropos of the discussion before about how money is created, I would say most of the, if you want to say blame, lies on fiscal policy,
Right.
because that was really what was creating the money that, to a large extent, the Fed then converted back into kind of base money or deposit money rather than government bonds. The Fed, yes, doubled the size of its balance sheet, but it wasn't the main player. The main player was the federal government creating a huge amount of new money in the economy. So clearly, too much money chasing not enough goods and services, that gives you inflation.
Right.
But what did they really get wrong? And I would argue that when you step back and think about it, the real forecasting error was on the supply side of the economy. You have the Great Resignation. And a number that I look at, I think just encapsulates, is the number of people not in the workforce. Because if you're not in the workforce, you don't have hands on deck creating stuff.
Right. So which number is that? Because there are a lot of
number of people. If you go back to 2020, that was 95 million people,
right,
out of a population of about 327 or so in the US. We're not in the workforce. That number jumped in 2 months from 95 to 103 million. So this was the COVID shock, just altered human behavior.
Mm-hmm.
People dropped out of the workforce.
Right.
Now, then you had the recovery. You had all that money thrown at the economy. And I don't blame the Fed and the administration for doing that per se, because, we could have been going into a really serious Great Depression.
For sure.
It was bad enough as it was. However, that number now is about 99.8 million. Just call it 100 million. So roughly, there are 5 million more people in the United States that are not in the workforce than you would have expected had COVID never happened.
Right.
So this was a supply side shock. And of course, those people were distributed through the economy in many times important choke points, like, truck drivers, warehouses, ports, etc. So the sort of amplification of that sort of labor shortage ricocheting through the economy and causing relative prices to sort of shift, but net be bid up, giving you 6, 7, 8% inflation. I think that was really coming from this labor market shock. So I would blame the Fed and the administration not so much for getting the demand side of the economy wrong, but for not really understanding what was going on the supply side. And in some ways, that's not too surprising, because the Fed essentially normally takes supply as more or less as a given.
Right.
Short term, it's pretty much fixed. And it's not really the Fed's job to worry about productivity growth and labor force participation, they would claim. Their job is to manage the demand side of the economy.
Right.
But you've got to manage the demand side of the economy relative to supply capacity.
Right.
We had this once in a century shock that completely sort of signal jammed the system.
Yeah. I mean, this is fascinating to me, because you can see it all come together with the impact on wages after that, as those people who were out of the market well, those companies need to hire more people. So what do? Raise the prices. Raise the salaries. Yeah, it's amazing to see through all those connections.
Can I throw in one thing, Rob,
Sure.
because which I don't hear many people talking about. One thing that is true through all of this is that inflation expectations, as measured, the way that people normally measure them, break evens, 5-year forward, expected inflation rate 5 years out, 551. If you looked at those charts, you hardly see any effect of COVID.
Right.
So I think one thing the Fed can take a little bit of solace from is, although they did really kind of mess up in terms of fighting the last war, I can explain what that means if you want me to, but also diagnosing the economy and getting the forecast wrong, certainly on the supply side,
Right.
the amount of demand stimulus, although they didn't control all of that, a lot of it was fiscal, but also their forecast for inflation, spectacularly wrong. What they have managed to do through this whole period is keep inflation expectations well anchored.
Yes.
And that's the key variable in the whole inflation targeting regime. So that's one kind of, the inflation expectations theory of inflation has been tested and in some sense has come through looking good. And that should mean with inflation expectations well anchored, inflation will come down to target. Problem is, while it's elevated and coming down slowly, that's extremely painful.
Right. And there's also the win. Yeah. And, also which
the
parts.
Win, yes. Yeah, the transient.
Right. Which parts will drop first. Yeah. That's of course, the difference between the theory and the real. But
I think there's also a communications issue because I think when central bankers like Jay Powell and even myself was writing about this a couple of years ago, central bankers and economists, when they say transient,
yes, transient.
They mean it will not will not lead to a permanent elevation of inflation.
Right.
But transient to the man or woman in the street means like paycheck to paycheck.
Right. Yeah, you have seen the data on that from the Fed. Yeah, so, yeah, it's hard to explain that when the price of eggs doubles. Yeah, so all right, well, so perhaps we should leave it there. I really think this book is fascinating, even if you already consider yourself up on different types of monetary policy. Do read this book. It asks some seemingly very simple questions in some delicious details. So thank you for being here, Paul.
Thanks, Rob. It was an absolute pleasure.
And thank you to those who have listened in today. I really appreciate your time and listening to this podcast and a future one. Until next time, I'm Rob Rowan.